I'm feeling more and more comfortable with precious metals and with the miners, just because they've had such a long correction. So we'll see. But I think if you keep your eyes on the prize, which is gold at $10,000 or $15,000 an ounce and silver at $200 an ounce, when the currency reset becomes a thing, that today's prices are kind of a gift. One last chance to get into some of these miners before they take off on their long, glorious arc to five baggers from here or whatever. So, I'm getting more and more confident that now is a good time to be adding to precious metals miner portfolios.
Global macro markets are fast approaching a critical tipping point as mounting national debt forces central banks into continuous currency devaluation. Savvy investors seeking real inflation protection are increasingly rotating capital away from paper assets and into hard commodities. John Rubino, a respected financial author and former Wall Street analyst, notes that gold and silver have established firm technical support levels following an extended cyclical correction. As governments resort to inflating away their obligations during an impending currency reset, gold is predicted to reach between $10,000 and $15,000 per ounce, while silver could surge toward $200 per ounce. Current price levels offer a rare window to acquire deeply discounted mining equities before they launch into five-fold upside trajectories. From an independent market perspective, pairing physical precious metals with high-tier junior miners provides an ideal hedge against systemic fiat debasement. Now, we present the clips from John Rubino's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
Over the past couple of years, gold, Bitcoin used to be called digital gold, but then real gold started outperforming digital gold. And it became clear that the big money that was looking at the possibility of a currency reset, et cetera, was moving into gold and not Bitcoin. And that was one thing that kind of tarnished Bitcoin a little bit. And then the Bitcoin treasury entities, in other words, companies that do one thing, but instead they start putting their money into Bitcoin. And then when their stock goes up, they sell their overpriced stock to buy more Bitcoin, and it became kind of a perpetual motion machine. They started to fail because Bitcoin went down, and a lot of these guys, Strategy in particular, they were way overexposed and had to start actually selling Bitcoin, which they were never going to do. And so that happened too. So yeah, Bitcoin has had a couple of things happen to kind of tarnish it. And that doesn't mean it's over or anything. It just means that this is a rough patch for Bitcoin and the other cryptos. And we'll just have to see how that goes too. Because, if the tech stock bubble bursts, decent chance that pulls cryptos down even further. But again, we'll have to see. I'm not making any specific predictions about any of this. It's been a serious correction in precious metals. Gold and silver went down dramatically and for a long time, and then the miners got whacked. There's a lot of miners out there that are down by a third or more. Some of them are down by 50% over the last 3 or 4 months. And so that's, if you assume that precious metals are in a long-term bull market, which is hard to deny because their value basically depends on what governments do with their currencies, and governments are taking on too much debt, which leaves them no choice but to inflate away their currencies, which is great for gold and silver. So long-term bull market, and this was a dramatic correction within that long-term bull market, but it's gone on for a while. It's pretty well advanced. We're moving out of the negative seasonality part of precious metals and into the months when usually they see some Asian demand, which usually elevates the price and everything. So I think there's a decent chance that we've bottomed. No, not a guarantee, but I think it's not a bad time to be picking up some of these mining stocks that have gotten much cheaper lately. And that's what I'm doing. I've got, low ball bids on some of the miners that have really gotten whacked. And if they drop another 10%, I'll get some more shares and things like that, which is how you want to behave at the bottom of a bull market, or I'm sorry, of a correction in a bull market. And so we'll see. Again, no way to know for sure, but I'm feeling more and more comfortable with precious metals and with the miners, just because they've had such a long correction. So we'll see. But I think if you keep your eyes on the prize, which is gold at $10,000 or $15,000 an ounce and silver at $200 an ounce, when the currency reset becomes a thing, that today's prices are kind of a gift. One last chance to get into some of these miners before they take off on their long, glorious arc to five baggers from here or whatever. So, I'm getting more and more confident that now is a good time to be adding to precious metals miner portfolios. I think gold and silver are at really trustworthy support levels right now. Gold is bouncing off 4,000, which is a big round number where there's probably a lot of buy orders in. Silver is not far from $55 an ounce, which is another reasonably dramatic number in trading. And so, I'm basing my adding to my precious metals mining portfolio to, just based on the fact that we have much bigger numbers out there somewhere. So almost any time now is a good time to be buying. But this is an unusually good time because we've got support, we've got seasonality, we've got, like you said, gold and silver will rally if we end the Iran war, and Trump's under a lot of electoral pressure to make that happen. It's really in his interest right now just to declare victory and pull out, just get it over with, let gas prices go back down before the election. So there's a lot of reasons to expect positive news from the point of view of gold and silver in the not too distant future. So yeah, that's those are the reasons that I'm seeming reasonably confident that gold and silver are going to do okay from here. And we'll see. But I started out putting stink bids on a lot of the miners at higher prices as they were going down, and I got a lot of those. So there's just a couple left that are down around these levels. And if I miss out on those, I'm basically happy because so many of the other ones got taken. But we'll see. It could be one more correction gets me completely out of buying the miners from here, and I'll just sit back and hope to watch it go up from here. I think energy is a good thing to own long term, but you do get these fluctuations because of geopolitics, right? And so, Exxon pays a good dividend. It's making a lot of money at today's prices. Might as well own it. And same for gas pipeline stocks and the other high quality oil companies. Everything related to energy, just about, is in a long-term bull market right now, just because we are so short electrons right now. We really need to build out the grid. Even if there was no AI bubble right now, even if the hyperscalers weren't doing what they're doing or anything, we still had an inadequate electrical grid going forward. We still needed more energy prior to the AI bubble, and that just turbocharged the process. So I think, the high quality solar companies, the oil companies, the gas companies, all of these guys, of course, the uranium companies, all of these stocks are probably good to own right now, just because the long-term trend, the really serious fundamentals are pointing towards more investment in the grid and in energy in general, and that's going to help their stock prices.
Japan stands as the world's most indebted nation per capita, facing severe macroeconomic turmoil as interest rates gradually rise away from zero. Central bank interventions offer only brief relief for the yen, which is projected to resume its steep downward trajectory once fundamental economic pressures take hold. Over $1 trillion remains tied up in the unwinding yen carry trade, threatening to trigger corporate debt defaults and systemic instability across global credit markets. Meanwhile, annual U.S. debt interest expenses have crossed $1.5 trillion, surpassing the defense budget and confirming an inescapable debt spiral. Analyzing this environment objectively, central banks are effectively trapped without viable policy tools, making severe currency depreciation and persistent inflation almost guaranteed for the foreseeable future. Now, let's get back to the interview.
Well, the background is that the Japanese government is the most indebted government on a per capita basis of any country ever. They've been just racking up big deficits and rising debt for several decades now. And that worked for them as long as they were able to keep their interest rates at zero. So their net interest cost was basically nothing on this debt that's piling up. But they can't do that anymore. Their interest rates are starting to rise. The bond markets aren't as impressed with Japanese debt anymore. And that's raising the interest expense on Japanese debt. And it's also weakening the yen. So we've seen a series of interventions, where the Japanese government dumps some of its dollar paper, uses the proceeds to buy back yen on the open market to try to support their currency, and it works for a little while, and then it doesn't work again. The yen's decline resumes, and so we're in the it works for a little while stage of the latest intervention, and it probably will not last. This spike up in the value of the yen is because some big players, in other words, the Japan Central Bank and the U.S. Central Bank intervened, bought the currency, made the price go up. But it'll start going back down again because the fundamentals point in that direction. The Japanese government is just over indebted. That usually weakens a currency going forward, and unless they fix it, the currency has a long way to fall. And that takes us to the yen carry trade, which is probably the reason for a lot of the intervention, because it used to be that you could borrow very cheaply in yen, turn around, use those yen to buy U.S. government debt or Brazilian debt or whatever, and make a big spread between those two interest rates. It's not as easy to do that anymore with Japanese interest rates up in the 2s and I guess for the 30-year, the 3% range. And so it's possible that there's an awful lot of bad paper out there based on what used to be the ability to roll over yen carry trades ad infinitum. And now they can't do that anymore. And so there's potentially some bad news and possibly financial crises that are going to flow from the end of the year yen carry trade. And the governments of the world would like to at least delay that, if not prevent it. So that's what's happening. And you can go in and move a market like, a currency like the yen that's not that deeply traded pretty easily on a given day. But then as soon as you stop, fundamentals resume and people are selling the currency. And I don't know what the fix is for something like that. Once you've reached a certain level of debt and your interest costs become sufficiently debilitating, and although that's not really that big of an issue for Japan because most Japanese debt is owned by Japanese entities. So it's more like a social program or something like that where money's being transferred within the country. But it's still potentially a problem if it leads to the yen carry trade not working anymore and a lot of bad paper blowing up because of that. And then it's still potentially a problem because we're talking $1 trillion or more dollars invested in yen carry trade deals. And depending on who it is that blows up first and what the next dominoes are to fall after that, it's potentially a big deal. It's potentially very dangerous. So I think they're trying to prevent that. They're just trying to push it off. In the U.S., we've got midterm elections coming up, and we don't want any unnecessary crises leading into it. Japan, they just have a new government come in here, and they would like their at least the first year to be placid. So they have reasons for intervening in the markets right now, but there isn't any hint of success in these interventions. It doesn't look like they're going to work going forward. And meanwhile, the Japanese government is just piling up more and more debt. So is the U.S. government. So these problems are going to get worse, and the solutions are going to diminish in their efficacy going forward. And we don't know where the breaking point is, but we're definitely headed that way. The problem now is that we're reaching the point where things aren't as easily controlled as they used to be. You get your interest cost, if you're a government reaching a certain level, like in the US, it's $1.5 trillion a year, which until this year was way more than the defense budget. So you can't really run a global military empire when your interest costs exceed your defense spending. And that's just one of the many numbers that don't work anymore. So there's all kinds of things that could go wrong going forward because we build up so much debt. And now the bond market's uncooperating, so the interest cost on that debt is soaring. Those are kind of death spiral events. And so I think you can make the case that we are in what will be looked back on as a currency death spiral. That doesn't say when it resolves or anything, but I think historians will look back and say, yeah, that's kind of when it began, when U.S. interest costs soared and Japan's went along with it, and there wasn't anything they could do about it.
Cryptocurrency markets are enduring heavy pressure as institutional capital shifts back toward physical gold bullion. Treasury models reliant on issuing overvalued stock to purchase digital tokens are unraveling under tight liquidity, and a tech stock bubble burst could pull cryptos down further. Conversely, global energy infrastructure is entering a massive long-term structural bull market driven by severe power grid deficits. Even without the immense electricity demands from artificial intelligence data centers, existing power grids remain fundamentally inadequate. Consequently, top-tier oil, natural gas, solar, and uranium companies are positioned for sustained multi-year upside as capital pours into power generation. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.